don't see the cost is looking. Yeah, good.
Everybody's on the app.
It's going to be a 10 to 45 minutes, isn't it?
Yes, this is where you hope I don't suddenly develop Tourette syndrome.
That wouldn't be ideal.
Wait, as far as I can see, looking at the audio input capture at the bottom, it's never gone above yellow. It seems to be upper end of green, so the level should be fine.
Let's check how that's logged on.
You should be okay.
Odd.
But then it is still early, isn't it? It's not like
Well, 3 minutes,
3 minutes.
I would have thought.
Right, let me check the link.
What does the banner look like in the background? Is it alright?
I can't see that. I can actually see, I can see that it's live, but I can't see the picture at all. Am I doing something wrong? I'm sure it's quite working, David.
Do you know what studio mode is?
No.
A little bit more. As long as it doesn't fall forward, because it was slightly resting on the wall behind.
That's what's wrong. Yeah.
Is it right now? Is it resting on the wall?
It's the good, it's not 49 seconds back.
That's alright. Yeah.
Yes, there's a bit of delay. You can see it, so the levels will start to go up a bit down.
Ladies and gentlemen, good morning and welcome to this second webinar on SME growth. This morning our subject is finance for growth, And it follows on from the previous webinar, which covered some of the earlier topics, such as grants, that we won't be covering this morning. But I hope taken together will give you a pretty full and rounded picture. By way of introduction, my name's David Gill. I'm the Managing Director of the St John's Innovation Centre here in Cambridge. I've been running St John's for 11 years. Before that, I used to run a seed fund, investing in technology companies. Before that, I set up and ran the innovation and technology team nationally for HSBC. And in between whiles, I took a bit of a sabbatical and I did my master's at Stanford University in California. So came back with some of the can-do attitude and tried to apply it here in the Cambridge cluster. Let me say a little bit about the MERLIN project itself for those of you who are not familiar with it. MERLIN aims to equip researchers and early-stage research-rich companies with the skills that would help them commercialise their research findings and successfully introduce them to the market. We've delivered a series of activities, including workshops, international conferences and meetups. The materials can be found on the MERLIN programme website, and a link will be provided following this telecom. Now, looking a little bit at the members of the MERLIN partnership, there's a list on the board here. There are 3 of us who are incubators. In addition to St John's, there's the Universidad Politécnica de Cartagena and Poznan Science and Technology Park. And our other 2 partners are 2 consultancies, BlueSpecs and Civita. So it's been a great pleasure to be able to work with organisations around Europe on this important programme. In due course, you will have full access to all these slides. We found this morning that a few vibes have got in, such as some of our graphics might have disappeared. But as and when you want to download the full slide pack, you'll get all the slides, all the data, and all the links. Now, moving on to what we're trying to do this morning, there are 2 key outcomes for this webinar. The first one is understanding the advantages and disadvantages of different types of funding. And this morning we'll be talking particularly about equity funding, such as the funding from angels. And then later on, once the companies have grown a bit, looking at the debt funding, such as funding available from banks. And related to that, as you can imagine, is understanding what are the appropriate sources of finance for your growth funds. There's a word that people in finance tend to use quite a lot when they say that all money is fungible, and by that they mean that when there's a euro or a dollar in your bank account, one is as good as the other. But actually, from the point of view of a startup company, that isn't quite true. And the characteristics of the funding you have, whether it's risk funding or whether it's much more secure, low-risk funding, will matter enormously, particularly to the people to whom you're pitching your proposal. Now, before I go on, let me say that on the right-hand side of your screen, you should be able to see that there is a tool by which you can communicate questions. And if you'd like to send us questions during this webinar, that'd be very helpful. And at the end of the 45 minutes or so, we will try to deal with all your questions. If there are some more complex ones that we need to research, we will come back to you and give you an answer on those as well. Running through the order of play before that, I hope that if we give you some sort of an overview of the entire finance landscape, that will help put into context several of the different types of finance which you might not have come across before. Particularly where we're talking, let's say, about the difference between angel funding and seed funding that might come from an institutional investor such as a venture capital fund. Sometimes you might have different types of options available to you, and what we will be covering is, does it work best if you bring them together? Are there circumstances where you should only use one rather than the other? Those are the kind of questions we'll be addressing. Most importantly, I think if you take the idea of aligning your business model for growth, you, by implication, if you're looking at this webinar, are an ambitious company that intends to grow, then what you need to do is to make sure that your business model will line up with the options available from the sources of finance. And most importantly, I think probably this is the one that we're really leading up to during the whole of this webinar, is understanding what life looks like on the other side of the table. In other words, what are investors looking for? How do you get your message across? How do you craft a message in such a way that the people who have the funding that you are seeking to access understand what you're talking about, become excited, become engaged with what you are looking for? So that's the agenda for this morning. And if I now move on to some of the substantive material, this is a graphic I've worked on for many years, so you could view it as a work in progress. But it's our way of trying to get across where the different types of funding fit in across the entire landscape, from when you merely have the first idea, right through to the time where maybe you've sold your business, or even in really exceptional, really unusual cases, you are able to float your company on a recognised stock exchange. Now, I'm aware that as the graphics appear on this board, they're perhaps not as clear as they could be, but don't worry, by the time comes for you to download the slide deck, we will have corrected all those little gremlins, all those little problems. The big point that I would hope to get across with this slide, though, is that in the middle, there has been for many years, I'd say probably all the time that I've been working with early stage growth companies, all the time that I've been involved with innovation, going right back to the early 1990s, there's always been a problem with having that bit in the middle that is so difficult to fund for a fast growth business. So on the one hand, right in the early stages, it's quite likely, when you're still tinkering about with an idea, that you'll be reliant on your family, your friends, your neighbours, your supporters to put in small amounts of money to help you get to the very, very basic proof of concept, the minimum viable product, as it's sometimes called. And once you've got to that stage, once you can go along to a professional investor and say, I have something that is really valuable, I've developed the solution to a really big problem in the market, whether it's technology or not, then you're in a position to access the more formal funding, by which I mean funds from people like business angels and venture capital funds, and we'll be talking about the differences between those two in a great deal during this webinar. And the likelihood is, in many countries, in many developed countries where governments and philanthropic foundations also provide grant funding, the likelihood is that if you can leverage the money you receive from investors with grants, grants being money you don't have to repay, grants are non-dilutive, they don't take part of your equity. If you can bring the two together, you've got a pretty powerful base to get right through to the next stage where you start to productize, you start to show that customers really do want to buy your product. And of course, if I could then cheat a little bit by going right to the top right-hand side of this slide and looking at the stage where you've already got a lot of customers and you can approach people like banks for expansion capital, and maybe you're even within a year or so of being able to do a trade sale or get another form of exit. At that stage, it's quite likely that lenders will take a serious interest in you. You'll be able to borrow money. And the great advantage of borrowing money, of course, is, again, it's not diluting your equity, it's not diluting your ownership. The downside is that with all forms of debt, ultimately they have to be repaid, and they also need servicing in the form of, for instance, paying interest. So that's the overall landscape. Our understanding of this is that in the middle there is going to be the gap that's often difficult to fill. And the longer your business goes on, the more you have customers, the likelihood it is that you are becoming a lower risk business. So the more you mature, the more you're able to move from having many different forms of uncertainty, many unknown factors that make it difficult for both you and your investors to work out what the proposition is, and you can move much more onto the stage of saying, we understand what the risks are, we can quantify them, we can minimise them, and we can become attractive to a much greater pool of investors. Now, that said, I think you'll probably got the message, subliminal or otherwise, from what I've been saying, that the most important source of funding for the overwhelming majority of businesses is always going to be the fact that people want to buy your product. It's one of the famous sayings that's come out of accelerator programs like Y Combinator. If you had one piece of advice to give to an entrepreneur, it's build stuff that people want or build stuff that people need. And by implication, they will pay you for it. And if they pay you for it, it begins to bring in the cash. So you won't need to go to investors so much, and you won't need to take on bank borrowing. But we fully appreciate, because we work in the world of technology startups, we fully appreciate that often it takes you, let's say, 3 or 4 years to get to the point where you've gone through proof of concept, gone through minimum viable product, and you've actually got something you can sell to people that they're prepared to pay you for on a regular basis. Another way of understanding some of the overall picture is that on the Merlin program, the likelihood is that you will be technology-based. You are a technology firm. And that has its good points and its bad points. Let's start by contrasting a tech firm with something which is much more of a people business. Something like a law firm or a consulting firm, where your main asset is getting highly qualified people, but you don't need to invest in a lot of equipment, you don't need to invest in manufacturing facilities. Anything which is capital and expensive, you can ignore. Whereas with a technology firm, the likelihood is, even with all the wonderful modern ways that we have, such as using the cloud, with the ways that we have of being able to do rapid prototyping, the likelihood is that in the first 2 or 3 years of the existence of your firm, you will need to invest heavily. And it's during that period that you will be contacting people like the equity investors. But why do you do it? You do it because once you've gone through the proof of concept stage, you can show that you can grow, you can scale, you can productize in a way that would not be true of a consulting firm. There's a slightly old-fashioned phrase used about consulting firms, which is that their assets take the elevator home of an evening. So if you're a consulting firm, you're not earning money whilst you're asleep. Whereas if you're a technology firm and you have a range of products which are being sold around the clock, around the world, you are, once you've got the products out there, able to make money 24/7. Let me, by way of wrapping up some of these preliminaries, just make a few points that we often have to discuss with entrepreneurs in the building, here in the incubator, and I suspect our fellow incubators in the Merlin program have the same issues. I think a lot of first-time entrepreneurs tend to take the view that because you need money, you're investment ready, whereas that's not the case at all. To be investment ready, you have to be in a position where you can show you've already sketched out what your fundamental proposition is, you can show what your path to market might be, what the milestones might be, you can show that you've got the beginnings of a team that an investor could put funds behind. In other words, you've built that business case and you understand what the problems are you've got to solve until you get to the point where you will be funded mainly by clients. Another issue is, I have a confession to make, which is I'm a lawyer by training, and I spent a large part of my professional life being not very numerate. And I had the great good fortune at one stage when I worked for HSBC to have a boss who taught me to be proficient in Excel. And I used to say to him, well, if you're building spreadsheets to analyze startups, then all you can do is show that if those assumptions were right, at some stage maybe you could get to break even. And he pointed out to me, well, actually, the real glory of having financial projections is you could see, would you ever be able to get into profitability or not? And sometimes, if you can't get into profitability, then maybe you need to come up with a different business model. You need to give up your proposal for good. So having financial projections which at least show how and under what circumstances you can get into profitability is going to be absolutely essential when you're talking to sources of investment. And finally, as you will probably have gathered by now, it isn't a case that all forms of money are the same. So you have to understand where you fit on that diagram of the risk profile, and therefore which type of source of capital you should be going to and what type of story you're going to tell them. And we'll move on to that in a little bit, but the story you'll be telling investors, people who provide equity or risk capital, will be different to the story you tell bankers, people who have a almost commodity view of finance and are not on the whole into taking risk. So it's understanding what is the right source, at what moment in your development, what story do you tell them, based on the view that each one of them has a different risk profile and has a different appetite for return as well. And that takes us on to what I consider the main sources of funding for high growth companies, particularly in the technology sector. And they are business angels and venture capital funds, or seed funds. And let us unpack that a little bit for you. Although they both provide equity, they both provide risk funding. In other words, they take a share of the ownership of the company, and they accept that with ownership comes both the possibility of greater reward if the company does well, but also the possibility of losing the funding because they have no security, no assets, nothing else to fall back on. They are owners just like you. Although both angels and venture capital funds are owners like you, the types of funding they provide are in many ways very different. And it comes down to this, that business angels are private individuals, sometimes acting alone, sometimes acting in formal or informal syndicates, who have the flexibility to support any type of sector or location, depending on what their preference or their own experience is. So they have complete discretion about the type of business they invest in. On the other hand, venture capital funds, the sort of funds that I used to manage before taking over running St. John's, venture capital funds are monies run by professionally employed investors on behalf of often people like pension funds and insurance companies who have a very restricted remit about what they can do. We don't have the latitude of saying this company looks exciting, we'll invest in it. We will have agreed with our investors that we will only invest in particular types of sector or particular stages of development. So that's a big difference between us. And over many years, I've had the pleasure of working with some of the leading researchers in the business angel world in the United Kingdom. I think at the moment it's still Colin Mason and Richard Harrison, who are both based in Scotland. And Colin, who I first met when he was an economic geographer, before he really got into the world of finance, started pioneering the definition of what an angel is. And I can't do anything better than the one he put in an academic article published just over 10 years ago. An angel is an individual, in other words, not a fund or a corporation, acting alone or in a formal or informal syndicate, who invests her own money directly in an unquoted business, a private business, with which there's no previous family connection or other connection of a close nature like that. And the angel has made, after making an investment, is actively engaged with the running of the business. And that, to me, with the companies that we have in this building, probably half of whom have been invested in by business angels, that to me is a transformative factor. It isn't just money you're getting from angels, it's their advice, it's their wisdom, their expertise. Because a lot of the angels in our world, in the Merlin world, are people who themselves were successful entrepreneurs who built up the money they have to invest through having previously run successful businesses. Now, you may ask yourself, what are the sort of things that an angel is looking for before making an investment? We've tried to cram down the many different questions that we hear when we run pitching events here with angels to just a few that we've summarised on this slide for you. The one that I would single out as being simply the most important of all is the people. So angels in particular will be backing usually a team with a leader. They're not just backing one individual. And often they recognise that when they invest in an early stage business, to use the jargon, that business is going to pivot. In other words, its business model might well change quite radically. But what really matters is the faith they have in the calibre of the people to deliver. So people will matter enormously. I think it's fair to say that a lot of angels also recognise that early stage teams might just be, let's say, 3 people. That would be typical for a company going into an accelerator. And they won't have all the skills they need. But if you're pitching to angels, it will help enormously if you can at least identify, you know what the gaps in your team are, and you can say how you will be able to fill those gaps. The other factor that I think often trips up first-time entrepreneurs is what equity investors, especially angels, are looking for is truly exceptional growth. Not that you're going to do 10% better, 30% better, but over a period of just 2 or 3 years, you will have done 20, 30 times better. That's the sort of thing they're looking for. And we'll come on to the returns they make on their investment in a moment. But the key point to recognise here is that the great majority of startups, even those that have gone through a highly selective filtering process to get to the stage of being considered by angel syndicates, the great majority of startups actually fail. So, if you're an angel investor and you've invested in, let's say, 10 startups, you need to know that the top 2 or 3 are going to do really, really well if you're going to get your money back, let alone make any kind of profit. Something else that's come up, I think, in the past 5 to 10 years is nowadays angels would probably have expected you to have done something to show that you're beyond just the idea stage. You can show that people would use your product, even if at the moment you haven't got to the point where you've got paying customers. And interestingly, this morning, as I was coming into work, I was listening to an interview on the BBC with one of the founders of Netflix, who was making the point that the real change between the world now and when Netflix was set up in the 1990s is back then, investors almost needed to back the hunch of the entrepreneur, whereas now with Amazon Web Services, with other forms of cloud computing, with the rapid prototyping you can do, with the whole move towards minimum viable product, investors will at least expect you to be able to show you've got something that people want. Quite how much they want it, quite how much they pay for it would be another issue. But remember, given that you must be the exceptional company if you're going to be invested in, the likelihood is that this is going to be a big gap in the market. This is a big hole to be filled that nobody had spotted before. And you've now identified it, and you have managed to convince the investors that you are the team. You have both the technical qualities and the commercial ability that can turn this idea into a business. We will also, in a moment, be talking about issues like valuation. They tend to be quite contentious, but we have ways of simplifying it, you'll be pleased to know. With valuation, though, comes the issue that most experienced angels know. Let's say at this stage you're asking a syndicate of angels to invest €500,000 in you. They know that with the great majority of technical firms, at some stage you'll be looking for a second and a third round investment. And what worries them is that their initial stake in the business, which might have been, let's say, 20% of the equity, will be sufficiently diluted that they end up with just 2% of the equity. They've taken all the risk, they've lived through the early, difficult, stressful years with you, and they aren't going to get the financial return. So that is something that you will need to confront. You will need to show what happens when you need the next round of investment. I think to some extent we've touched on this already. In the really, really early stages, the likelihood is that the only realistic source of funding for you will be working with angels. They have a fair amount of discretion, unlike the venture funds who are the stewards of other people's money. They can choose their sector, they can choose their location. In reality, in our experience, the great majority of angels like to be within easy travelling distance of the companies in which they invest. There are sometimes exceptions to that. The exceptions tend to include, for instance, if you're in a very specialist subsector. Let's just pick an example out of the air. If you're developing a product that relies on graphene, there are hardly any centres of graphene excellence around Europe, so people who are interested in graphene will be prepared to travel. But it's experience, I think, which dictates for many angels that often a lot of their companies do get into difficulties early on. They like to be hands-on investors. Therefore, they want to be able to come and see you and help you out at short notice when things do turn into a problematic situation. And finally, on the issue of what motivates venture investors as opposed to angels, you may have noticed, if you've looked into trying to access venture funding, or if you've read any of the specialist financial press, that there are more large funds who want to make large late-stage investments than there are early-stage funds. And part of that is driven by the fact that investing in early-stage companies is much more complicated. You don't have the data, you don't have the information, you're having to put in a lot more of your time and judgment. But part of it is also driven by financial reward. To put it simplistically, let's say you get, as an investor, a 20% bonus on all the profits you make for your investors, for the pension funds that have invested in you. So if you doubled their money, you get 20% of that. If you're investing 100 million euros and you manage to double that and you get 20% of the gain, you become very rich. Whereas if you've been investing 20 million euros in your fund, you're not going to become rich pretty quickly, even if you're a superstar investor. So that's one of the reasons why the venture funds tend to stick to big-ticket investments. In many European countries, and beyond for that matter, because governments have realised the significant impact that angels can have, bringing not just the funding, but the know-how and the drive, there are angel tax breaks. And typically what these tend to take the form of is, let's say I'm an angel investor and I put 100,000 euros into your company this year, I would be allowed to write some or all of that 100,000 off against the tax I would have to pay in that year. And if your company does as well as we all hope it does, then in 3 or 4 years' time, when you're sold for many, many times what I invested in, the capital gain I make would also be tax exempt. And that's a system that applies in many different countries, and it has helped enormously to lever in private funding, not just the cash but the expertise. And one of the good sides of that is that in a lot of countries, quite rightly, governments insist that angels can only invest in ordinary shares, the same type of shares that you, the entrepreneur, will have. And by implication, if the angel does well, you do well. If you do well, the angel does well. So both of your incentives are properly and fully aligned. And on that, I'd perhaps also say that our experience in the UK, which I think has been mirrored to some extent in France as well, is that in recent years, in the really early stages, at the seed and follow-on stage, there's been much more money going into the market from angels than there has been from the professionally run seed funds. So the tax breaks have helped enormously, and we must hope that they will continue to do so. When I wrap up this section on sources of funding, I think I should also mention that corporate investments are possible in many countries. If you can identify a large corporation who has a gap in its product delivery, in its product lineup, that you can meet, then working with the big corporation can accelerate your path to market quite considerably. And because they've got a whole machine behind them to do with product testing, to do with market alignment, that can accelerate how you develop as well. It's also true sometimes with working with smaller companies where the entrepreneur founders are of substantial means and they're often fired up with creativity. But what we do say is finding a corporate partner is easy, finding the right one that has a strategic interest that aligns with yours requires a great deal more work. Let me now move on to the very contentious subject of valuation. You won't be surprised to know that valuing an early stage business is really quite difficult. You haven't got much data to go on, and the phrase that we hear again and again from the entrepreneurs we work with are things such as, I don't want to give up control. I don't want to part with more than 50% of the equity. Or we hear entrepreneurs say, oh, I want to give away as little equity as possible. And what we have to push back with the entrepreneurs is to say that with equity, you're not giving anything away, you're selling part of a business. And therefore what really matters is negotiating the price. And the price here is both the monetary value and the added value that comes with it. Let me talk a little bit about some of the techniques that are involved. I'm going to guess that many of you over the years will have come across a lot of the professional valuation techniques that are used by big corporations, that are used by people like pension funds and stockbrokers for managing established businesses. And what those valuation techniques tend to have in common is the businesses they are valuing have got a lot of products, a lot of customers, they have got pretty regular income, which with better management they can improve or during a recession goes down. But one way or another, they've got the data they need to do the valuation. And most valuation techniques rely on being able to look at the cash income you're getting today, and then working out, let's say 20 years hence, what would that cash income be worth? And then you discount it to take account of things like interest rates and inflation, and you can come to a figure today that says a company turning over 100 million today, making profits of 8 million euros, I will be prepared to pay 80 million euros for it now, let us say. But the problem you have got as an early stage startup business is there are so many different input variables for which there's a range of values that you could argue about with your potential investors. And the valuation variables are so wide that sometimes on the same data, you and an external investor could come up with a huge range, so much so that you feel you're never going to reach agreement. But the point about trying at least to use some of the valuation techniques is you can agree a framework of what your company would be worth if it were able to hit these levels of income in year X, this level of profit in year Y, and you can work back from that to say, on that basis, this is what we think the company is worth today. So those are the basics that you can use. There are more materials on our website if you're interested, because it's a big and important topic. But I will conclude by saying that basically for valuation, you have to think about it as an informed negotiation, and therefore honing your negotiation technique is at least as important as looking at models such as discounted cash flows. So a very, very brief, and I appreciate probably truncated introduction to valuation. But I think I should now go on to the next of our big topics, which is looking at the differences between what banks are looking for on the one hand and what equity investors are looking for on the other. Now, equity investors are buying a stake in your business. They are taking a lot of risk because if the business doesn't work out, and as we know, something like 85–90% of all startups don't make it through about the first 3 years. So in return for taking a high risk, they want to get a high return. And in practice, with angel investors, they will be looking to get 10 times their initial stake back within a reasonable period of time. And reasonable in this circumstance probably means they're more than 5 years. So that's what they're looking for. Your reaction might be, well, that's pretty greedy. You know, they're looking to get 10 times their money back. That's exorbitant. But in practice, what a lot of the early stage investors have found through experience, through painful experience, is that of a portfolio of 10 investors, at least 3 will fail pretty quickly. There will be something like 4 which don't go anywhere and will be very difficult to find an exit for, very difficult to find a way out. So they're reliant on the final 3 not just to get back their original stakes in all 10, but also to make a profit. So if as a business angel, you have 3 superstar investments out of 10, you really are an exceptional performer. And there's quite a lot of academic evidence, both in Europe and the US, that shows you need somewhere between about 25 and 40 investments in startups as an angel to be sure of making a decent return. So talking to equity providers, people who are prepared to take this risk, you will need to be exceptionally convincing. And part of that is being able to boil down, reduce, simplify, clarify exactly what it is you do. Part of it is saying, here is a big problem that hasn't been solved before, saying, we are the people who can solve it because here's our technology, here's our product, and then showing how it's going to make money. What's your business model? What's your financial model? Because simply being able to solve the problem on its own is not going to be of sufficient interest to the investors. Something we touched on towards the beginning is the importance of the management team. Because at this stage there are so many unknowns, whether it's will your technology work, will people buy it, what price will they buy it, all those questions. What you have got to be is really convincing as a team. So the founders have got to be convincing, there's got to be something that's authentic, to use the jargon, about you in that space in which you occupy. And probably on the Merlin programme, because you're so heavily involved with ICT, the likelihood is that you will know far, far more about your vertical in the market than anybody else. So you have got a leg up doing that. But I would summarise this section by saying keep it brief, keep it clear, and where you've got all the technical analysis, put that in appendices. One of the joys of my job is each year I get to work on the student business competition here in Cambridge. What we find is in the first term, all the business plans have got hundreds and hundreds of footnotes as if they were going to be a refereed academic paper. By the time we get to the finalists, they simply have a few slides of great clarity and no footnotes at all. And that's probably what you should be aiming for right at the outset. Putting it another way, it's can you, with your executive summary, put on paper or on a slide something that is effectively the elevator pitch for your business. And you're probably all familiar with the elevator pitch. The idea is that you are the entrepreneur, you get into the elevator at the ground floor of a tall building with your dream investor, and you've only got until you get to the top of the building to convince her that she's really interested in your business, not that she's actually going to get the money out there and make the transfer, but enough that she will take your business plan and be prepared to perform due diligence on it. So your executive summary is like the elevator pitch for a oral delivery, is the written version of that. And on this section, it's probably only fair to say that if you've been reading the financial pages in recent years, you'll have noticed that in 2013, 14, 15, there was a huge excitement about the rise of the crowdfunding. And it started with debt but moved to equity. Fortunately, I think in the past year or two, some of the froth has come out of this market because a lot of the valuations that were being created by the online crowdfunding platforms were completely unrealistic. They were far too high. Now, as an entrepreneur, you might be saying to yourself, oh, I like a high valuation. It means I have to part with fewer of my shares. But what it also means is that when you've gone through the, let's say, 200,000, which might be the maximum that a crowdfunding platform can invest, and you then need to go to an early stage venture fund for 2 or 3 million euro to do the next round, the people who run the venture fund have got a much more realistic sense of valuation. They will bring the valuation right down to below how you were valued on the crowdfunding platform. That's called a crush down or a down round, and you will end up with a lot of small private investors who are very unhappy with you. So I think the new realism that's coming into crowdfunding is probably a good thing. Once you've raised the funding, how do you make sure you look after it properly? And there's obviously a whole amount of wisdom on this. I hope this is where you can work with your angels who've done it before. It might be at this stage also that you need to start employing a professional fund manager. But a few key concepts for you to understand managing your money. The first one is what's called the burn rate. Now, if, as a thought experiment, you think of your business as one which is already generating lots of cash, you're cash flow positive, in other words, you're generating more cash than you're using in the business, week on week, month on month, you can say, oh, I've made a surplus of €1,000 or €10,000. With a burn rate, you're looking at the opposite. A burn rate is negative cash flow. That's where you're not generating enough cash to get to break even each month. And your burn rate is the amount by which each week or each month you have to actually hit break even. And the key thing about that, if you can calculate your burn rate, and because you know how much money you've got in the bank from your investors, you will know how soon you run out of funding. And how soon you run out of funding will dictate your funding strategy. How soon do you need to go back to investors? And putting it very, very simplistically, the longer you've got before you run out of cash, the greater are your chances of being able to negotiate a good deal with your follow-on funders. As a rule of thumb, a lot of our startups in the really early stages have only got between 6 and 12 months of cash in the bank. Once you've got through to the venture funding stage, you've probably got between 12 and 24. But you're almost always thinking, when is my next funding round going to kick in? I hope by now many of you will have looked in a little bit to the key financial statements that investors, and for that matter, the company authorities and tax authorities in most countries require. If you have, you'll realise that there are three main ones. There's the balance sheet, which is a bit like a snapshot of how many assets you've got and what you owe other people at a given point in time, usually your year end, but you might want to do it at your month end. There's your profit and loss account, which shows how much money you've spent over a given period of time, let's say a year. But the key thing is the cash flow. If you are an early stage company, cash is what matters. Profit and loss account includes what's called sometimes accruals accounting. In other words, let's say you employed people to build you a laboratory and it cost €1 million, but they haven't invoiced you. They took 6 months to get round to invoicing you. In cash flow terms, you've had a 6 months holiday, but in P&L terms, you have to show the expense when it fell due. For you, it's always going to be the cash flow that counts. If you run out of cash, your business goes bust, and that can have serious implications for your ability to start a new business later. Let me start to wrap some of this up by giving you one or two little graphics that will help you think about where your cash is going. That red line is showing whether you're paying out more money than you're getting in the early years of your business. And it will feel like a magic moment when that red line, that red arrow, finally crosses the horizontal line at 0 again. Because at that point, you've got to break-even point, at least from the point of view of a debt provider. It may be a lot further down the line before you've paid back any of your other debts that you might have accrued, and you can start paying out dividends to your investors. But that crossing the line is a growing up point. It's almost like a sort of first communion for many entrepreneurs. And the last graphic I'm going to give you for now is a very simple one to help think about what your fixed costs are. Now, if you manage to control your fixed costs, so for instance, you're paying hardly anything by way of rent, you're not having to pay expensive services to build your own servers and the like because you can use everything in the cloud, then you won't have high fixed costs, and your costs should only vary pretty much in proportion to the sales you're making. So you can understand why in recent years it's been a great drive amongst entrepreneurs to want to bring down their fixed costs or their overheads. The more you can do that, the more your costs will be directly proportionate to the sales you're making. And if you can find a way on your Excel spreadsheet of showing yourself a way of stripping out fixed costs from variable costs, I think you'll find it very helpful for controlling your costs for the future. And now I'm going to come towards a summary, bringing together all we've been talking about in the past 40 minutes or so. And I'd reiterate that all these slides and more will be available. And the slides that will be available will have even more snazzy and easily digestible diagrams. But what I would want to say is you will be familiar with the old saying that the customer's always right. And if you've ever been involved with a customer-facing business, you want to say, well, that's not true. You know, often the people who use my restaurant are making really silly decisions. But it's not that matters. What really matters is the sense that you have to assume that the people you're dealing with have got an absolutely valid point of view. And again, what we hear from early stage entrepreneurs is it's the fault of the investors that they don't understand why my business is so wonderful, why my idea is going to change the paradigm of the industry. And that's why I love this quotation from Guy Kawasaki, who was one of the early senior managers at Apple and then ran Garage Technology Ventures. He pointed out that if investors don't understand what you've got, ultimately it's down to you, and you've got to find a way of improving your pitch so that they can understand what it is that is paradigm shifting, completely transformational about your business. And finally, you will probably have heard it from your mentors before, but it's worth repeating. Raising money takes longer than you expect. We have rarely, in all the years that we've been running St John's, seen a business get invested in less than 3 months, and usually it takes more than 6 months from when the business has first caught the interest of early stage investors like angels. You will find it difficult to estimate how much you need. It's one of those laws that no matter how well you've estimated it, you'll probably find that you need more. Often investors won't give you all the money up front. They will make their investment in 2 or 3 tranches conditional on you hitting various milestones. So you have to be resigned to that. And until you've got the cash flowing in such a way that you're not burning money, you have to rely on equity or grants, which were dealt with in the last webinar. I'm coming back to the idea of your burn rate and when you're out of cash. Don't forget, it's always easier to raise money when you're not desperate for it. So plan early, get in there, start talking to investors, even when you think you're not near the out of cash point. Good luck with all of that. Just giving a little heads up about what's coming up soon. In 5 weeks' time, there will be a workshop on the Merlin events calendar at the Abraham Institute here in Cambridge, and this is mastering the art of the elevator pitch. So how do you present to investors and indeed other stakeholders that you want to impress? And if you want to find out more, do please have a look at our website. Thank you very much. I'm now going to switch formats from the screen and we can deal with some of the questions. Oh, and I see my colleagues have very naughtily put in a plug for a book that I wrote with some of my venture capital colleagues a few years ago. If you're interested and if you want to learn languages at the same time, our book on raising money for entrepreneurs has been also translated into simplified Chinese, and you can find both versions on Amazon. So thank you very much. I'm now going to full cam. Now one of the behind the scenes technical helpers here has very kindly given me your questions, and I'm reading these for the first time as well, so I might have to think whilst I'm speaking. And the first question we had is, would you say there are different angels who look at B2B or B2C sectors only? I think that's a really good question, and I agree with the fundamental premise. I think around here in Cambridge, because so many of our angels are people who built up a technology business, we're more used to dealing with angels who are B2B. They understand what makes bigger companies operate. Whereas, for instance, the companies that we deal with here that are more consumer-facing, we quite often have to take to angel groups in London, because in London the angel groups have been dealing with the media, they've been dealing with consumer-type products. And they often have different drivers, but they both have a lot of value to add because they understand what it is that the customers you're seeking to access are looking for. So thank you very much for that question. Yes, there are different types of angels. There are a few who will be able to straddle both B2B and B2C, but probably a top tip for you and your advisors is recognise which sector you're in and use that to help you then identify which group of investors you want to approach in the first instance. Now, the second question is, do business angels take shares in return for their investment? What is a typical percentage of participations in a spin-off? And that is looking at what is the right mean, the right average for percentage of shareholdings. Well, yes, to the first part of that question, the answer is very much that angels do take shares. And partly because it's what they're used to, and partly because in many countries in Europe it's tax law that helps dictate this, the likelihood is that angels will be investing in ordinary shares, the same sort of shares that you as a founder would have. It's considerably more complicated in the United States, where there will be many different B class, C class, that kind of thing. But in Europe, it tends to be ordinary shares. It's the fundamental ownership. As for the percentage, I think most serious angels recognise that there are two parameters which limit the maximum and the minimum that they would aim to have as an initial percentage. And as a maximum, they recognise that you as the founders need to stay incentivised by having significant control. So they would not want to go anywhere near 50% ownership in a first round, particularly because most angels also recognise that their round is going to be the first of 3, 4, 5. So if they went right up to, let's say, 50% now, by the time the company has been fully funded to the point where it could undergo a trade sale, there would be hardly any equity left for the startups. I think on the MERLIN programme, we're lucky that most of the companies we're talking about are to do with ICT, not to do with life sciences, and in life sciences there are slightly different drivers because huge amounts more money are required. So first rule of thumb, angels will not go anywhere near 50% in a first round. Second rule of thumb, the angels know that they're going to be diluted in subsequent rounds. So they want to have a meaningful double-digit percentage in that early stage round. So I would expect an angel probably to end up somewhere between 20 and 30%. But that is just a rule of thumb. If you say it's 20% in this round, and then in the next round they do get diluted, they might still be down at 10%, which is meaningful when the company comes to be sold. But they know that there is the risk of being not just diluted, but going through a down round. In other words, the next round where a venture fund comes in and has a lower valuation to the one in which they invested. So I hope that answers that question. I see there's a third question's come in here. What do you normally recommend to startups when approaching business angels? Again, that's an absolutely superb question, because I think part of it is doing your research, understanding not just what is it that those angels are looking for, but looking at what have they done in the past. So it's not just what do they say, but what do they do. And there's one of the leading business angels that we deal with on a frequent basis, a man called Peter Cowaney, who I think is currently both chairman of Cambridge Angels and the European Business Angel Network. And Peter has written a wonderful book and has a website which is totally free to use called The Invested Investor. One of the points that Peter makes regularly when he addresses groups of early stage entrepreneurs, particularly those coming from an academic background, is do your research on me. If you look at my website, it will tell you the sectors I'm prepared to go into, the stage I'm prepared to go into, the degree of involvement I want to have. So if you come to me and say, I've got this great life science venture and I need €500,000, Peter knows immediately that you haven't done any research on him. And that is probably going to turn off his enthusiasm, not just for investing, but wanting to help you. So research your potential angels. What are their published parameters? What are they invested in before? And probably just importantly, within your technology cluster, talk to other entrepreneurs who might have been invested in them by those angels before. How did they behave? What were they like? Now, our next question, is it better to do bootstrapping or raise money irrespective of revenue generation? I think sometimes it will be circumstances that dictate the answer to that question. But given the way that things have moved on, with how relatively cheap and relatively easy it's been made to get to the stage of doing some early stage prototyping, showing what your product could do, showing whether people would buy it, the kind of minimum viable product type view of life, then in addition to keeping going through, maybe doing some consultancy work and maybe having family and friends, you will need to show that you've got a product that people can buy. So you're doing the two in tandem. You're doing the two in tandem is what I would look at on this one. The next question was, what techniques do you or business angel investors consider are an effective benchmark for valuing a company? Wow. And on that one, the answer would be relatively lengthy, and I can only simplify by saying that there are techniques, including spreadsheets, which I think we can make available to you via our website, that would show you if you hit a certain level of turnover and a certain level of profitability, let's say 5 years from now, if you actually had that data as a hypothesis to work on, you could then work back from what are companies in your sector being valued at today, for instance, by means of a multiple of earnings, and you can use that as a benchmark of what you would be worth in 5 years' time, and you can work back using standard discounting methods to what you are worth today. But that's when you get into the fact that a lot of entrepreneurs from technology background come from a mindset, a scientific mindset, where you have data, you have knowledge, and you don't move outside those parameters. Whereas real entrepreneurs know that they are always having to act on imperfect information, and they develop a comfort at being able to do so. Real entrepreneurs get pretty good at negotiation as well as quantification, and I don't think there's any shortcut around that. But it's a big question, and I hope that we can provide some materials that might help you with that. The next question we had is there a different approach we should take depending on if the startup is pre-sales or is already making sales and has good or early traction? And I think the answer to that follows on from the previous question. The more you have early traction, the more you've got the data, which means you're eliminating quite a lot of the uncertainties in your input variables, to use the jargon we used with the graphic earlier. So the more you've got the early traction, the more you can come up with a convincing, fact-based answer to how to value your business today. Now, question 7 was, I heard that some venture capitalists like to buy out early investors. How should we do structure friends and family and angel investment with the expectations of early exit to VCs? Woof. My answer to that one is, in the 25 years I've been doing this, I've only ever come across a handful of cases where venture investors are prepared to buy out early investors, for the simple reason that venture monies are rare, precious rocket fuel, and most of the venture funds take the view that that rocket fuel should only be used to enable the high potential company to accelerate its growth. It isn't to get out early investors or reward them in that way. What does sometimes happen, and you're probably at the really late stage of venture here, is you get to a point where a company is already generating revenues and it's possible to make some kind of internal market. But to the point of structuring your family and friends investment rounds, what I would say is try and keep your capitalization table, your ownership table, as clear and as simple as possible. And there are many available forms of online software that will help you do that. So keep it simple and make sure that you haven't got too much of a Gordian knot for the professional investors to unravel at a later stage. And I think we're coming down to our last couple of questions. The next one is, what level of turnover or profit would typically be considered too late stage for angels? I suspect that once you're at a level of profitability that your cash flow is fairly predictable, then angels would say the business is sufficiently de-risked that it's not one that we are likely to be able to pitch for. On the other hand, sometimes what I have worked with businesses where angels have been involved during the really tricky cash burning stages, and a little bit of extra money is required to enable the company really to accelerate. And rather than go out to new investors, a large angel syndicate, the sort of people who can afford to invest more than €500,000, will go in and invest rather than the formal venture capital fund. But once you're beginning to get predictable turnover and predictable profits and cash flow positive, it is quite possible that you have outgrown the angels. And our final question for this morning is there a tool or resource I can use to get an estimated valuation of my company when it's at MVP stage? I need to better understand what to offer up in exchange for investment. I think probably the straightforward answer to that is there isn't a tool, but working with mentors and coaches, we do have a number of techniques, including spreadsheets that we use here at St John's, which enable you to work out what you think your sales in 5 years' time will be, in 3 years' time will be, what your cash need will be, and therefore what your valuation could be at this stage. But when you're just at minimum viable product point, I think you have to recognise that any tool, such as a spreadsheet, and we have produced examples ourselves here, is only as good as both the assumptions you make and your ability to negotiate with investors, how convincing you are when you present your case. So I appreciate that's probably not the answer you wanted, but I think it's the realistic one. There isn't any one tool, but there are techniques that you can learn and practice. And I think my helpful assistants at this stage are telling me that I'm probably going to be disconnected. Thank you very much for listening to us. I hope you found it useful. The full slides, including the graphics, will be uploaded shortly. And we look forward to seeing you again soon at the next webinar, which will be based from the Bayham Centre in 5 weeks' time. Good.